Amongst all the talk of crypto, stocks and bonds are another item that will always remain popular, and in demand will be the exchange and trade of foreign currency, also known as Forex. In today's video, let's look at Forex trading, what it is, and how it works. Foreign exchange is the process of exchanging one currency into another one for the purposes of commerce, trading, or tourism. According to a 2019 triennial report from the Bank for International Settlements, a global bank for national central banks, the daily trading volume for Forex reached $6.6 trillion in April 2019. So, you can see how popular and in flow this method is with respect to fluency. But you might ask, what even is the Forex market? The foreign exchange market is where trading happens with regards to international currencies. Currencies are important because that's how you purchase resources and goods and services outside your own borders. For instance, if you are living in the United States and want to buy a special kind of locally made cheese from Italy, then either you or the company from which you buy the cheese has to pay Italy for the cheese in euros, EUR. This means that the importer in the United States would have to exchange the same amount of US dollars, USD, for euros. Just basic conversion, according to subjective and tentative rates that are prone to change every day, as there is no fixed price of a foreign currency. The same case applies in traveling. An Italian tourist in India can't pay in rupees to see the Taj Mahal because it's not a currency that's locally in use. And even if you acquire it, it won't be useful. The tourist basically has to exchange the euros for the local currency. In this case, for that of an Indian rupee, at the current exchange rate. However, it is interesting to note that one unique aspect of this international market is that there is no centralized marketplace for foreign exchange. Rather, Forex trade is usually conducted electronically and digitally over the counter, OTC, which means that all transactions take place via local computer networks among traders who are enlisted to trade on multiple traditional forums, rather than on one centralized exchange house. Because of a variety of reasons, such as convenience, time zone differential, and etc., the market is open 24 hours a day, 5.5 days a week. These currencies are traded all over the world in all the major financial hubs of Hong Kong, Frankfurt, Beijing, London, New York, Paris, Singapore, Sydney, Tokyo, and Zurich, across almost all the time zones that vary continentally. This means that when a regular US trading day ends, the Forex market then opens up all fresh and chirpy in Tokyo and Hong Kong. As such, the Forex market can be extremely volatile and subject to changes throughout the day, remaining active at any time of the day with price quotes changing constantly. This is another way for banks to make money as well. Most commercial and investment banks are the ones conducting most of the Forex radiating in those markets on behalf of their clients. But that's not to say that you have to rely on them. There are loads of speculative opportunities for trading one currency against another for professional and individual investors. Now, let's talk a bit about the technicalities of this and how you diversify your foreign currency when it comes to configuring asset classes. There are two distinct features to currencies as an asset class, and this applies to both individual and large-scale corporate investors. When trading, you can possibly earn the interest rate difference between two currencies, and that's a lot. What's more is that you can also profit from changes in the exchange rate, the constantly fluctuating prices. This is where the buying and holding tactic comes in. You simply buy a certain amount of foreign currency when its price is low and weak, and then hold on to them until the price grows stronger, selling them at profit. What's the harm in that? As you probably might understand, an investor can then profit from the differential of those two interest rates in two different economies by buying the currency with the larger interest rate and what's known in the financial world as shorting the currency with an interest rate that's lower. Prior to the 2008 stock market crash, it was a very common practice to short the Japanese yen, JPY, and buy British pounds, GBP, because the interest rate difference between them was very large. This strategy is sometimes referred to as a carry trade. But things weren't always this easy. Currency trading was a very tedious and difficult task for independent investors prior to the advent of the internet. Most currency traders used to be consolidated in the forms of large multinational corporations, hedge funds, or high net worth individuals because Forex trading required a lot of capital to begin with. With help from the internet's arrival, there seems to have emerged a retail market that is targeted at individual traders, providing access that is easy to the international foreign exchange channels through either the banks or investment brokers who are constructing a secondary market. So, in a nutshell, the FX market is where currencies are purchased and traded. It is the only constant and non-stop trading market in the world that ever closes down. In the past, the Forex market was dominated by conglomerates, institutional firms, and big powerful banks, which acted on behalf of clients and had their own monopoly. But it has become more decentralized and retail-oriented in recent years, and traders and investors of all types and backgrounds are more than ever present in the Forex scene. An interesting aspect of world Forex markets is that there are no physical infrastructure that functions as trading hubs or channels for Forex trading. Instead, it is a loop of various professional connections made through trading terminals and computer networks. Look at it this way. The participants in this market are themselves the investment banks, institutions, commercial banks, and retail investors. However, it is worth mentioning that foreign exchange markets are considered more hazy and non-transparent when compared with other trading avenues. Currencies traded in these OTC markets, where disclosures are not necessary, there are high liquidity pools from large institutional firms, which are an apparent feature of the market. While a normal individual would presume that a country's economic dynamic and their own currency strength should be the most important factor determining its price, that isn't the case. A survey conducted in 2019 found that the schemes of large financial organizations were the most important element in determining currency prices. But how do we get started? There are the spot, forwards, and futures markets, as follows. Forex trading in the spot market has always been the most prolific and quantitative because it trades the largest underlying real assets for the forwards and futures markets. There have been times where volumes in the forwards and futures markets surpass those of the spot markets. When people, individual investors, refer to the Forex market, they usually are referring to the spot market. The forwards and futures markets tend to be more in association with companies that need to hedge their foreign exchange risks out to a specific time in the near future. How does the spot market work? The spot market is basically where currencies are bought and sold based on their contemporary trading price. That price is accounted for by supply and demand and is calculated based on a variety of factors, including current interest rates, sentiment toward ongoing local and international political climates, economic performance/trajectory, and the perception of the future performance of one currency fighting against the other. A finalized deal is known as a spot deal, and it is a bilateral transaction in which one party delivers an agreed-upon currency amount to the counterparty and receives a specified amount of another currency at the agreed-upon exchange rate value. After a position is closed, the settlement is in cash. What are forwards and futures markets? A forward contract is a classified agreement between two parties to buy a currency at a fixed future date and at a predetermined price in the OTC markets that is regulated. The main difference between the spot market and the forwards and futures markets is that the latter do not trade actual currencies. They deal in contracts and links that reassign claims to a certain currency type and a future date for settlement. In the forwards market, these contracts are bought and sold between two interested groups, who settle the terms of the agreement amongst themselves. In the futures market, futures contracts are purchased and sold based upon a customary size settlement date on public commodity channels, such as the Chicago Mercantile Exchange. For example, in the U.S., the National Futures Association regulates the futures market. These futures contracts have specified details, including the number of units being traded, delivery and settlement dates, and minimum price increments that cannot be customized. The exchange acts as a counterparty to the trader, providing clearance and settlement services. Source: Investopedia. Both types of contracts are commitment-based and are typically settled via cash at the exchange in question upon expiry, although the contracts can also be bought and sold before they run out of their usage date. Usually, big international corporations use these markets to hedge and then short against future exchange fluctuations. But independent speculators take part in these markets as well. That's all for today, folks. I'll see you in the next video.